Hello students, welcome to my class. This is Professor Vicente Sayai, and this is the presentation of part 2 of chapter 9. Chapter 9, plant assets, natural resources, and intangibles. In part 1, we talk about the basic accounting principles relative to plant assets, and we also talk about the application of those principles. Now, part 2 continues from where we stopped in part 1. Here we are talking about lump sum purchases. So this is a situation whereby we purchase multiple plant assets for a lump sum. In other words, we buy 2-3 different plant assets, but we pay only one lump sum. The question is, how do we allocate the lump sum that we paid among the multiple assets that we purchase? So we call these lump sum purchases. Another name for it is basket purchase. So let's take a look at so those are the rules. The last bullet is we are going to allocate the cost or the cost of the multiple assets that we purchase to each asset based on the relative market value. So let's take a look at the application of the rules. So here is an example that we are going to use to illustrate these principles. On August 1st, 1, Smart Touch Learning purchased land and building with a $100,000 note. The land is appraised at $30,000 and the building is appraised at $90,000. So we issued a note for $100,000. So we are buying the piece of land and the piece of the building for $100,000. So the question is, how do we split this $100,000 between these two different types of assets? Like we said, we use the relative market value. So let's take a look at how that works. So we said that the market value of the land is $30,000 and the market value of the building is $90,000 for a total of $120,000. That is the total market value. That is what these two items of property or plant asset are worth. However, we only paid $100,000. So if you do the math, we have to compute the percentage of the total value for each plant asset. In this case, the market value of the land is $30,000. You divide that by $120,000, that gives you 25%. And the building market value is $90,000. You divide that by 120, and that will give you 75%. So we are going to use those percentages as a basis for allocating the $100,000 that we paid for both of them. So let's take a look at how that works. So we multiply 25% by 100,000, that gives us 25,000. We multiply 75% by 100,000, that gives us 75,000. So we have split the 100,000 between land and building for $25,000 and $75,000 respectively. So that is how we work out the lump sum purchases. Now let's take a look at how we make the journal entry. We now debit land for $25,000. Debit building for $75,000 and credit a note payable for $100,000. It is important. Some students get confused with the appraised value of the multiple assets or the the multiple assets or the different assets that we purchase with the lump sum. The market value of each item or each plant asset that we purchase is only used as a basis for the allocation of what we pay for the plant assets. Moving along, let's take a look at objective 2. Here we are going to talk about how to account for depreciation using three different methods. So the first issue is, the question is, what is depreciation? Here we are told that first of all, I want you to know that the accounting definition of depreciation is completely different from the ordinary English meaning of depreciation. So in English, when you hear about the word depreciation, one of the things that comes to your mind is something losing value. Why that has a connection with what we are doing here, but the definition of depreciation for accounting purposes is quite different. So here we said that the first bullet is plant assets are recorded as assets are purchased. We did talk about that previously. Now, let's take a look at what we have here. So suppose we bought a piece of equipment for $10,000. Here is the spirit of the rule. The $10,000 equipment very likely will last us more than 1 year. So in order to be in compliance with the matching principle, we said that we should match our expenses with the revenues that they generate. The $10,000 that we paid for the equipment has to be split over the years that we are going to use this plant asset as, or have to be split over the useful life of the plant asset. So for simplicity purpose, assume that we are going to use this equipment, or we anticipate of using this equipment for 5 years. So we divide 10,000 by 5 years, that will give us $2,000. So we are going to allocate and split the $10,000 over 5 years period. That is the definition of depreciation in accounting. So we said here it is simply the allocation of the cost of a plant asset over its useful life. Now, when we do that, what happens? We debit depreciation expense for $2,000 and we credit accumulated depreciation for $2,000. Accumulated depreciation is a contra account. Remember we talked about this in previous chapter. A contra account is an account that offsets another account. In this case, accumulated depreciation is a contra account to the related plant asset account. We are going to illustrate that in a minute. So here are the factors that we take into consideration in computing depreciation. 3 factors. Number 1, we have to come up with the estimated useful life. Like the example that I just illustrated, I said we anticipate that we are going to use the plant asset for 5 years. Actually, how many years we are going to use it, we really don't know for sure. So the key word is an estimate. Then number 2, we are also going to come up with an estimate of the residual value. What do we mean by residual value? Another name for it is salvage value. That is what we anticipate that the plant asset is going to be worth at the end of the useful life. We really don't know how much we are going to be able to sell it for, or how much it's going to be worth at the end of this useful life. So we come up with an estimate. Then the third factor is the cost. That is the only factor that is not an estimate. So of these 3 factors, 2 are estimate, 1 is actual. And we already talked about how to measure or how to calculate the cost of plant asset in part 1 of this presentation. So, moving along, we said that there are 3 common depreciation methods, okay? Straight line, unit of production, and declining balance. So let's take a look at the facts that we are going to use to illustrate these 3 methods of depreciation. So here, the cost of a truck is $41,000. We estimated that at the end of the useful life, we might be able to sell it for $1,000. So the residual value, or the salvage value, we call it, is $1,000. So you subtract $1,000 from $41,000, that gives you $40,000. So we call that depreciable cost. What does that mean? Depreciable cost meaning that is the cost that we are going to depreciate over the useful life. So the useful life here is 5 years. Another way of determining the useful life of a plant asset like this, a truck, is to take a look at the useful life in units, in this case in mileage. So we figured out that by the time we drive this truck for 100,000 miles, that probably would be the end of the life of the truck. So let's take a look at the straight line method formula. We said that the annual straight line method is calculated as such: cost minus residual value divided by the estimated useful life, in this case in years. Straight line, like we are told here, is the most is used the most, and it is easily understood. It is widely used because it is the most straightforward of the three methods. So here, let's take a look at the application of what we just discussed. The cost is $41,000, the residual value is $1,000, and the useful life is 5 years. So you do the math, we come up with $8,000. So the depreciation expense each year for 5 years would be $8,000 each year for 5 years, for a total of $40,000. So that is the depreciable cost. Now, let's take a look at the journal entry. So what do we do here? We debit depreciation expense struck for $8,000, and we credit accumulated depreciation struck for $8,000. Like we said, the accumulated depreciation is a contra account. So let's take a look at the second method. This method is called unit of production method. This method, unlike straight line method that gives you the same depreciation expense every year throughout the useful life of the plant asset, this method is a function of the usage. It is calculated based on how much you use the plant asset. So in this case, so let's take a look at the first again. For the $1,000 cost, residual value is $1,000. And in this case, the unit is 100,000 miles. So let's take a look at the application. So the first thing we do is to compute the depreciation per unit. So here is the formula for calculating the depreciation per unit. Number one, we back out the residual value of 1,000 from the cost of 41,000. That gives us 40,000. So we divide the $40,000 by the useful life, in this case in units, and that will be 100,000 miles. So we come up with 40 cents per mile. So let's take a look at the second step. The second step is to multiply the depreciation per unit, in this case 40 cents, by the number of miles that the truck was driven in a particular year. So in this first year, we drove the truck for 20,000. So 20,000 multiplied by 40 cents, that gives you $8,000 in depreciation in the first year. And of course, in subsequent years, the depreciation expense is based on the number of usage. You have to excuse me for a minute. So, actually, that is the conclusion of part 2 of chapter 9 presentation. We will talk about the double declining balance method and other issues in part 3.